China's official MBS manufacturing PMI met the market's expectation in June, reporting a third consecutive monthly contraction. The longer this trend persists, the more gloom pervades participants' central view for China, and the risks are thought skewed. However, the market's premise conflicts with historical priors and current global context. Domestically, June's MBS PMI reading of 49 is just 1.5 percentage points below the average of the series over the 5 years preceding the pandemic. Comparing cross-border, the decline in manufacturing activity reported for China through Q2 is a fraction of that recently seen in the US and Europe, with average prints of 49 for China versus 47 and 45 for the US and Euro area. Also of note is that the US ISM Manufacturing Index is now 7 percentage points below its 5-year pre-pandemic average, a deviation 5 times that seen in China. Looking back at the fixed asset investment detail from May, not only is China's manufacturing sector showing resilience, it actually continues to expand. While total private fixed asset investment has stalled as a result of the uncertainty surrounding consumption, investment in manufacturing continues to grow robustly, up 6% year to date. The subsector detail also points to burgeoning income opportunities, with high-tech manufacturing investment up 15% year to date. While the MBS definition of high-tech is not entirely clear, their detailed data points to several subsectors performing strongly. In May, electrical machinery and equipment investment was up 39% year to date, automobile investment 18%, and chemical capital expenditure 16%. Each of these subsectors are tied to Asia's economic development and the global green transition. Anecdotes further point to the value add produced by assembly operations, as well as legacy industries such as apparel, growing via automation and offshoring of production. Key ways in which China is seeking to mitigate the impact of rising wage costs and declining population growth. Note, domestic investment that is lost offshore is made up for by repatriated profits, as production remains under Chinese ownership. These structural trends offer considerable opportunity for economic growth and a more equitable distribution of income across the population. However, this will take time, as significant change in government taxation and spending is required, as well as a shift in household investment away from residential property to financial instruments such as equities. China's authorities know that change of this scale takes time and is likely to prove bumpy, particularly while the developed world is weak. They also believe that structural reforms need to be preserved if they are to bear fruit. While many in the market hope for quick and bold action by authorities, the reality is that to be sustainable, spending must be justified by the agents undertaking it, not purchased by the government. A multifaceted but passive approach to support is therefore necessary, including lower deposit requirements to incentivise home buyers and investors, a reduced reserve requirement ratio and increased local government bond quota to bring forward and support infrastructure investment, as well as some incentives to spur household consumption. If successful, currency and equity markets will respond, riding the signs of stress that concern the market today. We'll see you next time.